The S&P 500 is at new all-time highs, and all of the US stock investors are pretty happy about it. Well, not all of them. I said the US stock investors, because if you invest in the S&P 500, basically in the major 500 companies in the US market, and you're not out of the US, then you have a slight problem. In order to illustrate this and also give a solution to this, first we're going to check out the charts. So this is the S&P 500 index. This is just the index. This is not an ETF. You cannot invest in the index. You need to invest in the ETFs. But the index, which tracks the major 5 companies and their moves over the time, had a major peak. Or let's first of all start off with the fact that from year to date, so starting from the 1st of January till today, which is the 3rd of July, where the market closed because the US market was not open yesterday, which was the 4th of July, hit a new all-time high. So first of all, it hit a all-time high on the 19th of February. Then it went down and it hit the bottom on the 8th of April. And then it went not right back up, but it went back up again. And we are currently at a 6,279 S&P 500 from a 6,144 previous peak in February. If also we would take a look at a more detailed charts, where you can see this major bullish run just going over the 50-day moving average, over the 100-day moving average, which is the blue line, and the 200-day moving average, which is the red line. And we saw that major correction after February going down, even surpassing the 200-day moving average, which had investors obviously freaked out. This was due to the tariffs. So the first correction, which was the supposed tariffs of 10%, then the market starting rallying back, went over the 200 moving average, held it for 2 days almost. On the 3rd day, then Liberation Day, Trump came out and told us what the real tariffs will be, and then it went down again. Now we are at new all-time highs, even the 50-day crossing the 100-day and 200-day moving average, which is a major bull run. So this is if you are in the US, took your US dollars, put them in the stock market, and just had a major recovery from the lows, also being at currently, let's just see, 6.37% in plus if you would invest it in the markets. But you cannot invest in the markets only if you take a ETF, which, for example, for the US markets will be the SPY S&P 500 ETF, which, as you can see, is also a new all-time high. So basically, this is just mirroring the companies. As each time you buy this ETF, the ETF goes out and buys shares in that company, and you own shares in each and every company. So what European investors do, they can also buy not specifically this index, but another one, which is similar to this. Just that the trading platform where we are buying, Europeans, I'm from Europe, where we are buying the ETF is, for example, you need different platforms. You can buy it on the German, on the London Stock Exchange, German Stock Exchange, French Stock Exchange, so far and so on. But we cannot invest dollars only if you have a dollar account and you would have it based in a dollar bank. You can only invest in the European stock market. And here is the same ETF, exactly the same ETF with all-time highs in February, but not all-time highs right now. So what is the problem? Why is the European ETF, which is exactly the same thing, exactly the same amount invested in Nvidia, exactly the same amount invested in Microsoft, Apple, everything is exactly the same with one small caveat, and that is the euro-dollar difference. So if you're not invested in dollars, if you haven't taken your dollars and invest them in the S&P 500, but you take in euros and invested them in the S&P 500 or yen or whatever other value to which, or whatever other currency to which the dollar has devaluated, then you are down. Although the US stock market is up. So let me show you a different chart, and this is the European euro pegged to the US dollar. And we can see, if you go to February, go here to February, we can see a major downturn in, for example, where do we have the less highs? Let's go to the S&P. So let's take the 18th of February. Go to the euro dollar and let's search for the 18th of February. January. And there we go, almost there. The 18th of February. And we can see that the dollar was equal to 1.4 euros. So if you would come to Europe and said, here are my dollars, so let's take it this way. I would come to the US, take my euros, and say, here's 1 euro, give me dollars. Then I would get 1.04 dollars for my euros. At the current state, I would get 1.77, so $1.70 for my euros. In February, I would have gotten $1.04, and now I would get, well, basically 13 cents more for my euros. So you would say, why is this a problem? Well, the problem is that at the height of the stock market, back in February, the dollar was more powerful and the euro was not. So it was more powerful than the dollar, but it was less powerful than now. The euro is more powerful now, meaning that if I would, let's just take a calculator. And let's say here, so take out the calculator, let's say that we want to know how much in percentage is the difference between, let's say, 1.0, so we can have the same dates, 1.04 divided by 1.17, that is 88%, meaning the difference between them is 12%, almost 12%. So between 18th of February and now, the euro appreciated 12% to the dollar, or the dollar depreciated 12%. Reverse that, and let's go now to the stock market. The difference now between, let's say, this is just an ETF, okay, so forget about the prices. The prices in February were 14.32 for that SPY, the same SPY, okay? It was, so if I want to buy one share in that ETF, it would cost me 14.32 euros, and now it would cost me 12.94 euros. Once again, let's see what the difference is. Let's say 12.94 divided, what do we have there? 14.4, and it's almost the same difference. You see, it was 88, 88 is 89. So there was a small appreciation, depreciation still. So that is why the European investors are furious right now, because the euro is stronger, the dollar is weaker, and although the dollar stock market is at all-time highs, we cannot participate in that. Now, this also has one major setback for the US investors. Although the US stock market is at new all-time highs, and if we would sell your stock, you would get your dollars, you would still have, and remember, the tariffs. If you would buy something from the European Union, you would still have to pay 18 to 19% more. So I just hit my microphone. You still have to pay 18 or 19% more on that value. So let's say you would buy a car, it's 18 to 19% more expensive now than it was in February. Meaning, although the stock market is near all-time highs, your purchasing power in the US is not at all-time highs. It would be much better to have roughly the same currency difference. And when is a weak currency good? A weak currency is good when you're exporting. The US market is not a strong exporting market, it's a strong servicing market. The US market has like 18%, something like that. Yeah, I believe it's 18% manufacturing, and the major bulk of it, 70%, is services. Google, Facebook, so on and so on. It's services. So the problem is, when you have a weak dollar, your purchasing power for your imports, because the US is a net importer of goods, went actually down. Your purchasing power went down. So although I'm from the Europe and I do support and do understand and support President Trump's policies, this is a problem for everyone. Not only the Europeans, not only the Chinese, not only the Indian markets, is also a problem for the US because your purchasing power keeps devaluating unless you start producing in your own country. And that's not going to happen because iPhones will then explode to $3,000. But hope you understood now. Now, there is a solution. For the Europeans, there is a slight solution. I wouldn't recommend it, but there is a solution. So, for example, you're in Europe and you want to invest in the US stock market. So, how can you do it without losing right now value? I wouldn't recommend it. You can invest in something called a hedged, not a hedge fund, but a hedge ETF, which always hedges the euro to the dollar. So, you would be roughly there right now. But as soon as this will keep, because just take a look at the diagram here. So we are on the euro dollar. It was oversold down here, and now it was overbought once here on the RSI, so on the relative strength index. Then it went down, then it was overbought once more, and now it's overbought once more, but it's still climbing. So I don't think this is over. You need to wait a bit. What could change this is some interest rate cuts from the Fed, which will probably not happen till September or something major happens. So I wouldn't count on a cut in July now. That's the only thing that would change. So once more, if you want if you're in Europe and want to counteract this, then you could invest in a hedge ETF. There is one that you can access. I wouldn't recommend it because you would lose then when this reverses, you would lose then the appreciation of the dollar, and the dollar will reappreciate. It's not going to be over the euro, I believe, but it will reappreciate. So, hope you understood this. I'm Norbert BM. This was Wealth Done. Like and subscribe. Catch you in the next one. Bye bye.